Unless you've been living under a rock, you will know by now that the market has crashed on the back of Donald Trump's tariff policy. The crash has been aggressive, nearly as aggressive as the AI rendering in this picture of my eyebrows. It is down 15% in 3 weeks. Today we're going to talk through what are the implications and what are we going to do about it. How big a problem is this crash? Now let me get a pointer out. Now this is to the end of March, so it doesn't take into account the last 2 days worth of big falls, but there it is. There's the NASDAQ, so that's the pointer end of the US economy. The stock market, it is the tech heavy stuff, and you can see that it was off 11%. Now in the last 2 days it's off even further. It's down about 15% in 3 weeks. That's scary stuff. But if we have a look at the last 6 months, we go, okay, well, despite a 15% fall in 3 weeks, it is still up. If you have a look at 12 months, again, still up. You can see this really big sort of hairy, scary fall down here. It is confronting. So that is the US market. What does it mean for us? Now, I know that you've heard me bang on about diversification before, but let's see diversification in play. And as a reminder, diversification is not all of our eggs in one basket, but spreading the risk across a whole bunch of different investment styles and specifics. So this is, in the dotted black line, this is an aggressive portfolio, for want of a better term. It is about 90% shares and property, and it's got 10% more conservative stuff, bonds and cash and some sleep at night stuff. You can see the size of the fall in the NASDAQ there, really, really significant. We've still got a fall there. It's not really as big. And if we put it in terms of a bar graph, yes, it is down for an aggressive portfolio, but what's that, 1.5%? It's probably not as confronting as we may have expected. If you look at the last 6 months, it's up. Look at the last 12 months, it's up. Now that again is despite that incredibly big fall. If we have a look at something less aggressive, a portfolio that's probably got 80% shares and property, 20% cash and bonds, that sleep at night stuff, you can see, yes, there's a drop in the last 3 weeks. But it's nowhere near as big a drop as if we were 100% foot to the floor in one particular niche or segment. Again, you can see there's a drop, about 1%. It's not nearly as confronting as you might be expecting. Still ahead after 6 months and ahead after 12 months. Well, what if we took another step back and took around about maybe somewhere between a 60 and 70% shares and property, 30 to 40% sleep at night, in the form of cash and bonds? There is still a drop. Yes, it has ticked away, and certainly over the 3 months, but now we're starting to look pretty hard to see where that drop has been. And if we look at it over the 12 months, we're ahead. This is the value of diversification, and yes, we don't get as high a high in the good times when everything runs away, but there's not sort of panic at the disco when the market drops. So what are we going to do at this point? It is a wait and see. And the reason that I say wait and see is because we do not have consistency with Trump. He can say one thing today and the exact opposite tomorrow. We don't have consistency. We don't have long-term outlooks. At this point, it's a wait and see. We're not piling money to the market. We're not ripping money out of the market. We've got really good quality portfolios. They are really well diversified, and you can see the impact of that diversification there. We can look at the 12-month and go, despite the fact that we've fallen, the markets are ahead over 12 months. Hopefully you can breathe. If anybody is worried, you know where I am, you know how to get hold of me. Please reach out and let me know. But for the moment, please don't panic.